everyone. The face before you is Nande Boss, and I am the Communications Manager at GraySwan. On behalf of all of us here, I'd like to extend a warm welcome to everyone who's joining us live today and everyone who will be watching the replay later. The reason why you are here today is because you accepted an invitation from GraySwan to come and spend an hour of talking all things Megatrend investing. Now, I know that being aware of these global trends is something else, but having strategies in response to these global trends is something else. So I'm very excited that as we talk strategy around Megatrend investing, we've got the most experienced gentleman at our company and in the industry speaking to us today. And before I welcome them up, I do want to encourage everyone on the call today to engage with us. We'll be launching some polls, and we've made our Q&A, our question and answer window available for you to type your questions as the presentation goes on, and we'll give our speakers an opportunity to respond to those. Fantastic. So without further ado, I'd like to introduce our speakers today. We have Greg Theron, who is our Chief Investment Officer at GraySwan. Greg will talk to us about the global investment opportunities and give us a short overview of the Rand. After him, we'll have Duncan. Duncan will give us more details around the strategies that we implement at GraySwan. So stay engaged, and over to you, Greg.
Stunning. Thank you very much. Well, good morning, everyone. Thank you for taking the time in joining us at this webinar. So let's just kick off talking about investments and how we've been disrupted. I think a lot of you may be tired of watching Netflix or not knowing which series to watch on Netflix or watching reruns on DSTV. So I would advise you watch, or rather you read the book, The Black Swan. And the book is about the impact of highly improbable events and how it impacts us in humanity and how it impacts financial markets. And adding back to that, it's exactly what's happened now. We've been disrupted by the COVID-19 coronavirus, and it's had a big impact on us and how we operate as human beings, and it will have an impact on how the world operates, I think, over the next years to come. And therefore, I believe we need to think a bit differently in terms of investments, and I think there's some great opportunities lying ahead. So Jim Rogers, one of the, I believe one of the greatest investors of all time, makes a statement. He says, I cannot invest the way I want the world to be. I have to invest the way the world is. And therefore, what we need to do as advisors or investment managers, we need to look out for new opportunities in the way we think the world's going to operate in future. We've been disrupted and things has changed, and things will change looking forward. So again, I think you need to change your investment strategy and incorporate some new thinking into your investments. We don't throw the baby out the bathtub. We still believe in long-term asset allocations. Asset allocations drives your investment strategies, and by research, 95% of performance we know comes from asset allocations. And what do I mean by that? I mean, how much equities or local equities I'm holding, how much offshore equities I'm holding, how much bonds, how much property. These decisions are the drivers of performance over the long term. So we still believe in that, as I believe that is the way to get to your long-term inflation targets. But around this, you need to rethink some of your investment strategies. A great example is in 1948, where two brothers first unveiled the first Land Rover, a great car. And for those of you that travel into Africa or love traveling into the continent, you still see these vehicles. And the point is that some things that works doesn't need to be changed. You can still hold on to it, but you can combine it with newer technologies, newer ideas, newer investment thinking. And therefore, looking forward, we do think that you should be combining sort of the old with the new. And with that, an example is really our GraySwan Cautious Fund, a fund where it is really driven by long-term asset allocations and investment decisions based on the income needs of our clients. The asset allocation still drives the investment performance. So get your core strong, get your asset allocation strong, and then start adding, different ways of thinking or investment opportunities around that. So from a market perspective, and again, why do we think you need to start thinking a bit differently? Because when equity markets are at low valuations, then it's easy just to hold on to equity markets, but it's unfortunately not the environment we are currently in. If you look at the forward price to earnings ratio of the S&P 500, today it's trading at levels we've last seen just prior to the tech bubble. So therefore, equity market valuations are not cheap. We know equity market valuations are not cheap, and there's a reason for this, because of very low bond yields or very low interest rates. And the environment we're possibly going into is where interest rates starts hiking, where inflation starts coming through. And the point is just that over the last 15 years, where bond yields have just come down, interest rates have come down, you can't just invest in the same way, because the environment, we think, is not going to be the same. And therefore, you need to start making structural shifts to your portfolio. Within the equity space, there's various styles you can invest into. And one of the styles we've been speaking about from the beginning of this year is really the value style. So we do believe that within equity markets as a whole, you shouldn't just look at equity markets as a whole. You should really look at the different buckets or styles within equity markets. And we believe that as yields or bond yields starts increasing, you could see this rotation, which you've already seen, further rotation into value stocks. So therefore, there is opportunities in the equity market, even though the broader equity market looks quite expensive because of this big weighting to a couple of tech stocks. On the right-hand side, you can see the valuation of value stocks versus growth stocks. And the point of the slide is just we are at a level now where value stocks is the cheapest we've seen in roughly 20 years. And as interest rate starts going up, potentially, this is where there's some great value in the sector. So you need to, again, change your portfolios. What's worked over the last 10 years or 15 years is not necessarily going to work in the future. Then we look at entry points. When we look at asset managers which we invest into or styles we invest into, I think you need to be a bit more active in this environment, because again, the environment's changed. This is the 91 Global Franchise Fund. It is a very good fund. It invests into quality type businesses. And the slide here shows you the 12-month rolling outperformance or underperformance of the fund relative to global equity markets. And you can see the volatility of out or underperforming performance during various periods of time. The point is, quality type stocks which the franchise fund invests into have lagged during this last cycle or last couple of months, and we think there's a great opportunity here. So what you need to do is start sorting away from normal equity market portfolios and look for opportunities in the equity market. So we think this is a good opportunity to invest into this fund manager after the big underperformance you've just experienced. Within that, I've also mentioned the forward price to earnings ratio of the S&P 500 being quite expensive or very expensive. And therefore, we still think that you need to be invested a bit more conservatively at that point in time. And it's not just about, selling out of your equity exposure. It's rather within your equity components moving into more defensive parts of the equity market. And this slide just shows you in the very dark green bar how the franchise fund actually outperforms markets during times of stress. So that's a way to actually put some protection within your portfolios. And then also, if the view is that interest rate starts going up, that the Fed starts tapering some of the Fed purchases, then potentially you're not going to see these big rallies in equity markets going forward. And therefore, when you have moderate markets, then this type of strategy would do well. So it's really about re-looking your investment opportunities in the environment we're going into. What you also need to look at in terms of disruptions and what has changed is ESG. Duncan will speak about ESG factors in more detail. But one of the biggest drivers in terms of ESG, in terms of environmental, social, and governance, is this drive towards thermal coal, to divest out of thermal coal, to reduce carbon emissions. If you look at the Paris Climate Agreement which President Biden signed into again, and the US will try and get to zero carbon emissions by 2050. The European Union as well. That will be one of the biggest drives you've seen in terms of infrastructure spending to disinvest from coal or thermal coal. And therefore, you need to ask yourself, these big producers or oil producers, for instance, in the next 20 years' time, are they still going to be big components of the markets? And this is where you need to sort of look through the cycles and look forward to where the opportunities are. Then what we also think is that you need to start reducing your home bias. The slide on the left-hand side shows you the percentage of domestic equity as a percentage of total equity exposure which is invested in your own country. So there, if you look at South Africa, out of your whole equity exposure, which depending on your risk profile could be 70%, 65% of that 70%, typically for pension funds, are invested in South African equities. And then you have to ask yourself, well, if we look at the light green line, or bar there rather, what percentage is your local equity exposure as a percentage of world equities? So you can see there that South African equity exposure is only 0.5% of the global equity markets. And therefore, there's got to be a lot of opportunities out there outside of the South African markets to firstly diversify you, but to invest into great other companies, which we on the JSE do not have. You can think of Taiwan Semiconductors, for instance, one of the biggest conductor producers in the world. And if you think where we're going within the next 20 years, there's going to be a big demand for this. So therefore, these are opportunities, and you need to sort of look outside of the South African investment environment. The rand is going to be key. It's key to take money abroad at the right time, but I'll speak about that in a slide or two to come. On the right-hand side, you look at 91 Asset Management, just their view in terms of the potential growth in asset classes looking forward relative to inflation +6 there. And it shows you that if you are an aggressive investor to try and reach that inflation +6 target, you will need to invest into aggressive assets. We know you need to invest into SA equities and global equities, but the point behind the slide is from their perspective, they think the biggest opportunities is in global stocks, equity markets outside of South Africa. And therefore, we do think that it's a good opportune time to start taking money abroad. In terms of the South African market, and this slide just shows you, the universe of shares across the globe, 41,755, of which so the South African roughly only has 289. But for the big asset managers, that universe is not close to that because of liquidity constraints. So it's much less than that. And that tells you immediately how small the South African environment or shares are as a percentage of global shares. There's some great opportunities out there. So again, from that perspective, we think you need to diversify your risk from a South African perspective and look for great opportunities out there. From a rand perspective, it's critical not to panic when the rand blows out, and when the rand strengthens dramatically, it's usually a great time to start taking money abroad. On the right-hand side there, it just shows you a slide by Nedbank, and all that it basically shows you is that where the rand's trading currently, it's trading roughly below fair value, meaning it's stronger than the rand should be. And the view looking forward is that the rand would start depreciating over time. Why would this happen? Well, if you go back to the Fed meeting the middle of June, where the US Fed indicated that inflation surprised them on the upside, and that meant there may potentially be interest rate increases earlier than expected. Prior to this, the rand was trading at 13.50. We saw the rand moving from 13.50 to roughly 14.30 in a day. So the movements are big, and it just shows you the risk in the currency as the US Fed starts pulling back stimulus, as the US Fed starts increasing interest rates globally, and therefore that would also cause this liquidity dry up in the dollar. And if liquidity starts drying up in the dollar, then potentially what you start seeing is the dollar strengthening and the rand start weakening. So from that point in time, we think, or from here on in rather, we think it's a good opportunity to start taking money abroad at current levels. This slide just shows you from a quantitative perspective, very simplistically, over 12-month rolling performance period. If you look at the currency, you can see the movement of the currency. During the 2000 tech bubble, the rand depreciated by 60% against the dollar at that point in time. If you look at 2008, 50% against the US dollar. During COVID, we breached close to 30% against the US dollar over a 12-month rolling period. But the key factor, what you need to look at here, is the red dotted line at the bottom. That shows you a 2 standard deviation strengthening of the rand, meaning a sort of non-normal strengthening or abnormal strengthening of the currency. And at these points in time, it's typically a good time to start taking money abroad. But is it time for new thinking? That's the question. If the rand is strong and it's a good time to take money abroad, where do you put your money? And I think this is where it's quite critical in terms of where the world's going over the next 10 years. We think it's a time where you do need to relook your investment strategies and look into the future and ask yourself what has happened historically or what has worked historically. Is this going to work in the future? So if you look back in history, this is during the Spanish flu of 1918, and we've extracted some articles out of newspapers, not articles, rather, marketing by companies in newspapers. And if you look at the left-hand side, this was by Bell Services, which was one of the big telephone companies at that point in time. And where they state in the advert, when in quarantine, people who are in quarantine are not isolated if they have a Bell telephone. On the right-hand side, if you look at, when people were quarantined during the Spanish flu, what do you see? Order by telephone. Very similar to what we've seen during this quarantine period or lockdown across the globe. What is the point here? The point is that if you look at the telephone was invented 42 years before the Spanish flu. So it took 42 years for people to really start using the telephone. But what was the event that caused people to start using the telephone more? Well, the Spanish flu, where people were isolated and needed to communicate. So it's events that causes us as humans to start using technologies much quicker. And that's exactly what happened here. And it's exactly what's happened in this cycle. Unfortunately, just for interest's sake, during that Spanish flu, the issue with the telephone was that, you had the ladies sitting within the telephone lines having to move the lines around. And of course, they were in an isolated space with a lot of people close to them, and they unfortunately got sick. So that unfortunately wasn't great for the telephone in those days, but technology's changed. We don't have these issues today. But the point is just that, events drives us as human beings to change and use technologies quicker. And how has this worked through time? If you look back in history, and if you go back to various technologies, in the late 1700s, you had the steam engine. You moved on to railways. And if you recall, railways were some of the biggest stocks on the stock, or biggest companies, within the globe at that point in time. And then they were disrupted by airlines. And so various technologies or various industries get disrupted through time by new technologies. You see the telephone there, which is, during that Spanish flu, and how people adopted that technology over time, and then electricity came through. And then from the 1980s, you started seeing a lot of new technologies coming on board. You had the internet technology, which really drove the likes of Apple, Microsoft, Facebook, and so forth. But the point of the slide is there's a lot of new disruptive technologies which have come online, which we think is going to drive markets over the next 10 years. You can think about artificial intelligence, energy storage. A lot of us with the ESCOM issues we're having at the moment, a lot of us are moving to solar technologies, moving to solar power. Energy needs to be stored. Energy needs to be stored with the use of batteries. Batteries requires lithium, for instance. So there's a lot of new technologies which are coming on board, and this is the way the world's going. So you need to look at where we are today and where we're going to be in 10 years' time and start investing the way the world is going to be. Blockchain technology, another great example. Even though we can't advise on Bitcoin, it's not regulated by the regulator. But the technology of blockchain, do we believe, will be a big disruptor within the way even financial markets operate? And therefore, we think it's a great investment opportunity to invest into blockchain businesses. So you need to change and invest into how the world's moving. And if you look on the right-hand side, it's just a quote by Bill Gates. And he says, we always overestimate the change that will occur in the next 2 years. We overestimate it, but we underestimate the change that will occur in the next 10 years. And don't let yourself be lulled into inaction. And I'll repeat, don't let yourself be lulled into inaction. And this is what we're trying to do. We believe you should be making active decisions to incorporate new type of thinking within your portfolios in terms of how the world's going to work. This slide just shows you originally how within the equity markets, how investors typically think. And if you look at different styles, the big style is value style or growth style. And then within the market capitalization, you look at large caps, mid caps, small caps. That's the normal thinking of investment managers. But what we do think is you need to incorporate innovation. You need to incorporate new thinking. And that will give you an edge looking over the next couple of years in terms of reaching investment targets. Some of the big ideas for 2021 in terms of this thematic investing we speak about, these themes which we think will drive markets looking forward, are already, if you think of electric vehicles, automation of everything, 3D printing. You should go Google how the first house was 3D printed. It's amazing how quickly it happens. These are disruptive technologies which will change the way we operate as human beings. Multi-cancer screenings, cell and gene therapy. These are new technologies. You need to look at this. And then also you have different themes you can invest into. You can get the thematic funds or the trend funds, we call it. And within that, I've spoken about smart energy, which is your renewable sectors, smart mobility and so forth. So there's very, very exciting opportunities we believe you should be looking at as an investor. So how do you access these investment opportunities? That's always the big question. So in North America and within Europe, the growth on the left-hand side in terms of thematic funds has been dramatic. There's a lot of investments going into these type of investment vehicles, and it's not just active management, it's also passive management. You can access it via cheaper ETFs. On the right-hand side, you see the growth of thematic funds, assets under management. And there again, you can see the dramatic growth into thematic funds. And we believe it's only the start of this. The issue, though, is that the FSCA limits advisors to sell non-FSCA approved funds. And therefore, investors are very limited in terms of trying to access these thematic global funds. So at GraySwan, what we try to do is within our FSCA licenses is to provide product or to assist clients in terms of managing or investing into these thematic or disruptive portfolios, whereby you can invest into some of these great opportunities abroad. In normal circumstances, investors can only invest into these few FSCA regulated funds. Duncan will speak about passive and ETFs as well. And the key is you can read this book as well, Winning the Loser's Game by Charles Ellis. And the idea behind the book is really about how hard it is for active managers to outperform the markets, and for active equity managers to outperform the markets. And therefore, it's almost a loser's game going into active asset management. There are a few guys that can do it, but buying into passive, cheap strategies is the right way to do. We've been doing it for a long time with our clients, but it's a combination of active and passive. Duncan will also speak then about investing into these disruptive technologies. So you can invest into passive vehicles, which are cheap, via an ETF, but you can then access these disruption or megatrend portfolios, which we've been speaking about across the globe very cheaply. So we believe that's a way to access some of these opportunities. We've been working on all these disruption portfolios for 2 years and more, and we've structured various of them. We have a GraySwan's Global Equity Disruption Portfolio, a Health Innovation Fund, a blockchain and cybersecurity portfolios. And Duncan will speak into more detail on this, but I think these are great investment opportunities. It's the way we think the world is going to work, and we think incorporating these new megatrend strategies and thematic investment strategies into your normal core investment portfolios will give you a great opportunity to make good money in future. So I'll finish off with that. Duncan will just speak a bit further on all the mega trend funds and give you more detail on that. Thank you.
Thank you very much, Greg, and good morning to all the participants that dialed in this morning. It's clear that we've hit the spot with the very topical investment strategy that many of you are very interested in, so welcome. Albert, I see you've joined all the way from 91 Investex. I think you're smiling when you see some of the slides that we're showing on the franchise fund. I mean, Greg mentioned that a core part of our strategy is passive investing, but there are active investment managers that have successfully shown that they can beat the market. Unfortunately, there are very few of them. And there are good times to enter those managers, and there's also times to take profits. And as Greg showed, the Investec 91 franchise fund is one to consider at this time, together with your tracker funds, your thematic investments, and so forth. Wimpy, I also see you've joined. Met Wimpy yesterday in our offices, told him about what we're doing today, and I see he's dialed in. So welcome to everybody, and Greg, thanks for setting the foundation and the base. I did learn this morning that two brothers invented the Land Rover, which was news to me. And I've recently actually bought a Land Rover. I didn't buy the old 1960s version, but I bought a newer version with new technology, with innovation. A bit of a combination of the old school thinking as well as thinking about the future. So that was a great analogy. What I'd like to take you through are more of the thinking around the portfolios that we've created that Greg showed you in a glimpse. We have created 5 portfolios, which we've been running for about 6 to 7 months, some of them quite recent. And I'd like to give you more insights into these portfolios. Unfortunately, this morning, we wanted to show you a little YouTube video by this little kid, and it's called Pep Talk. We'll send it to you in an email post the webinar. Some technical difficulties made it not possible. But if you go and look at this little video, it's this little cute guy that gives a very, very important message. He talks about, let's create space jam. Let's stop being boring. Boring is easy. It's time to do something, man, but it's hard. And this is our time. We've got to work. We've got to get into it. And we've got to create something in the world that's going to be awesome. I mean, we look at that and say, we want to create something in the world for our investors that is awesome. And he also talks about taking the road less traveled, as that will make all the difference. That's a poem from Robert Frost, and that was actually the inspiration for starting GraySwan 11 years back, to take the road less traveled, to do different things for our clients, and to create that space jam. Now, what is space jam? I'm going to show you a little bit about that today. Before I do that, I want to reflect on a slide that I showed for the first time 3 years back, when we started this journey of finding something different. And I showed this slide to an audience here at the Lawrenceford Wine Farm. And I show these two swimming pools. And I ask the question, why is it that when we get into a swimming pool, do we always swim up and down in the length of the swimming pool? And I think that habit is created because we swim, let's say, a gym, and there's these lines. We have to swim up and down the line. We don't want to inconvenience anybody. But why is it that when we get back home into our own pool with no lines, do we continue swimming that way? And I posted that question to the audience. And one of the gentlemen said, well, that's the furthest distance that you can swim in your pool. So that's how you get the most exercise. But in fact, it's not the longest distance. The longest distance is across, and not just in the length. So it just shows you how we've all become accustomed to certain thinking, and we're all thinking the same. And we have to start thinking differently. And we set out ourselves to do something differently 3 years back. And it's been a journey, and I can tell you it's been hard, man. It's not easy, but at least it's not boring. And it's a very exciting journey. I can tell you that as hard as we've worked, we've been too slow. We should have brought these ideas forward much sooner, because the world is changing so fast. You can see on the left-hand side, I mean, just all these disruptive innovations. I mean, one of the first ones were the flush toilet. And, it took 30 to 40 years before most people started adopting it. But once the adoption rate is there, it moves quickly. And these days, you can just see when you're looking at the color TV or the computer or a cell phone, adoption rates are very, very fast. And therefore, it just means that for us as investment advisors and wealth managers, we have to think faster. We have to develop ideas faster. It's taken us 3 years to get here, but I wish we could have moved faster. But at least we're in the game. At least we've got a strategy. We've got a plan. And I believe that we are ready for the next decade. Why am I talking about the next 10 years? It's because we have seen every decade has a key investment theme. If you look on the right-hand side of that slide. And that theme is a big driver of performance. And of course, we know that, for example, the previous decade, it's been these FANG stocks, Facebook, Amazon, Netflix, Google. And we all sit here thinking that we wish we had more exposure to these shares. But it was very hard to actually, with perfect foresight, to say that these were the shares that were going to perform so well. Now that we look back, it's kind of a given that they should have done so well, because they were the innovators, they were the new thinkers, they were adopting, they were the first. But the question mark is now, what is that trend or that theme for the next decade or the next 10 years? And how can we identify that? Which are going to be the stocks? And it's hard, man. It's not easy to go and find them. And I can tell you that the smartest active asset managers in the world don't get it right. In fact, 60 to 70% of active investment managers can't beat the benchmark. 90% of them can't beat the benchmark consistently. So there are very, very few skillful investment managers out there to go and find the new themes, these new stocks. And even if they exist, it's hard to find these managers in advance. And they don't always repeat their previous track records of the past. So it is not easy. But what we think the best chances going forward is, yes, there are managers that can do it. So we'll most surely invest some of our clients' money in those managers. But we'll also invest passively. And we'll also invest thematically. Thematically meaning that we think your best chance of finding those outstanding performing shares of the next decade is to find the themes, such as, and Greg mentioned a few of them, blockchain, artificial intelligence, autonomous vehicles. There are many of these themes. And if one can just be on the wave of the theme, if you're a surfer, it's not about exactly where you enter that wave, but just get onto the right wave. And we just want to be on the next best theme, and there are various of these themes. So we don't want to miss out. And therefore, we've started investing according to what we call megatrends. And megatrends are just big changes that impact our lives, our businesses, our investments. These are things such as demographic changes, such as urbanization, such as technological advancements, things such as environmental, social, and governance, responsible investment thinking. And these themes are going to drive the world. It's already driving the world. It's really started making an impact as of COVID last year. I think the whole world's woken up to these themes. We started seeing these things 3-4 years back. We started researching it. And then COVID happened. And we wish we were a year or two sooner for our clients to really have extracted the significant value by investing in these themes sooner. But we're here now, and we've got a plan, we've got a strategy, and our clients have started investing about 6-7 months ago when we launched a lot of these ideas. Greg mentioned that, you know, we can have these best ideas, but unfortunately, as investment advisors, we are constrained. The regulator does not allow us to advise our clients to invest in non-approved FSCA product. Now, if you look at the universe of offshore investment opportunities, in fact, there's about 100,000 opportunities, funds, ETFs, shares, but the regulator says that we can only invest in the ones that are approved in South Africa. Now, that approved list is more or less 1,000. So we are very constrained, and we'd like to give our clients the best opportunities. The only way we can do that is if we operate within what we call an investment manager type environment under a different license, a license called a Category 2 and a Category 2A investment manager license. We have those licenses. And if we construct portfolios using that ability, then we can offer those portfolios to our clients. So initially, when we started our business, we started as an advisor, but we have realized over time that unfortunately, just operating as an advisor we operate in a very constrained universe, and we're seeing all these great opportunities, and we have to give our clients access. So for some of our clients, we will always act as an investment advisor. We will have no discretion. We will give you advice. You will approve. Only then will we implement. But there are clients that says, I want your best investment views unconstrained. And for those clients, we have constructed portfolios. I mean, if you look at what we did 4 years back, we constructed unit trust portfolios for our private client investors, like the one Greg showed you, that courses inflation plus 2 portfolio, and it's consistently beaten its peers at lower risk and at lower fees. And that's exactly what we want to do. Now, if you go and look at the thematic universe, you'd potentially be surprised to know that purely in tracker fund, meaning passive, low-cost, exchange-traded funds, there are 134 offshore thematic funds that has track records of longer than 10 years. And before, Greg showed you that if we act as an advisor, there's only a universe of about 50. And they don't have these long track records. But if we start putting things into portfolios for our clients under our Category 2 license, there's 134 that's got 10-year track records that we can consider. And therefore, we've just realized we have to build more portfolio ideas that are diversified as best as we can and not just simply give advice within a very constrained regulatory environment. So, what is our thinking and how does our thinking and our process work? So this is what we've implemented through our investment process. We took about a year to build a database of 56,000 odd actively managed funds and exchange traded funds. And when COVID struck, we were actually on our way overseas to go and meet with all the actively managed funds, but we couldn't. And then we realized that COVID's going to be around for a long time. If you recall March 2019, we wrote about a 15-page research article saying that this is going to be around for a long time. It wasn't going to be a flash in the pan. And we realized that because we're constrained in terms of traveling and doing due diligences and going to these offices of these investment managers, another solution for our clients would be to focus more on exchange-traded funds, passively managed tracker vehicles that gives you broad exposure. And we started putting more focus on exchange-traded funds. And you can see there are about 5,153 of these type funds. we screen them further and we say, well, we want to invest typically in funds that have a 3-year track record and longer. And we know more than 130's got 10-year track records. Then what we do is we start searching in terms of a library of innovative terms that we've built. And I'll show you a snapshot right now. And we also screen and say, well, we want to invest in funds that at least have about $25 million. They must be sizable for our private client investors to invest in. And furthermore, we've put a cap on fees. We don't want to invest in funds that charge more than 75 basis points or 0.75. And 0.75 is about half of what an average actively managed offshore fund charges. That's the cap or the highest ceiling that we'll pay. In fact, finally, if you look through our portfolios, most of the underlying funds in which we invest costs less than 0.35%. And then once we've done all the screening, we put it through a rigorous test, what we call the SWAN rating or ranking process, or the sleep well at night ranking process. And we look for 4- and 5-star funds. Here's a snapshot of just our library. So we looked at this whole universe and we defined what are the words or the themes or the trends that we're looking for to invest. And this library helps us to go and find funds when we search through this universe of 55,000 funds. And here you can just see, if we just go and look at specific terms such as, let's take one for example, healthcare innovation. There are 14 funds that's got a 10-year plus track record. There are 19 funds, and these are all exchange-traded funds, low-cost vehicles to invest in. There's 19 with an 8-year track record, 21 with a longer than a 5-year track record, and 3 with a track record longer than 3 years. You can look at healthcare innovation, 14 exchange-traded funds with a longer than a 10-year track record. There's 27 with a longer than a 3-year track record. So there's an investable universe of exchange-traded funds that give you broad exposure to all these different themes that we want to invest in and at low cost. So, and this is a universe that most of the African investors are not aware of, and most advisors are not aware of because they're not thinking this way. And then we run these funds through our sleep well at night ranking process, and we give them a ranking. And this is not just based on performance. It's based on performance and 5 different ways of looking at risk-adjusted performance. And we put certain weightings to numbers. The longer the track record, the better. So we put a bigger weighting on 10-year numbers than on, for example, the 3-year numbers. And finally, we come up with scores to rate these funds, after which we start spending more qualitative work. I'd like to show you maybe just 2 snapshots of 2 investment management businesses that we found through this process. And one is ARK Invest. Greg showed you some of their research. We found them about 2 years back, and we started engaging with them. At that time, they were a fund management business of only $2 billion. Nobody knew about them. Today, they are managing $60 billion of assets under management. The whole world's woken up to what this manager is doing and their new and innovative thinking. So we still like this manager. We're investing in some of the exchange-traded funds, but we've again realized, but okay, everybody knows about them now. Who's the next ARK Invest? Here's an example of somebody else that we found. It's an investment manager that really focuses on cybersecurity, blockchain, on soft commodities like cannabis. And there are many of these managers. Like Greg showed you that one research piece, just the increase in thematic investment funds in the world. And this is what we're focusing our attention on, is finding these managers for our clients. What do we do then? Well, we build portfolios. And Greg showed you this slide. We've constructed these 5 portfolios, from a disruption equity portfolio to healthcare innovation, blockchain technology, and cybersecurity. Also a new addition, and we're going to have a webinar, I think on the 30th of July, about investing for commodities for change. Not investing in the old type school, thinking only gold and oil, but thinking about the future and combining old school thinking with new school thinking. And one that I'm going to show you maybe just a slide or 2 on smart property investing. We started doing work in the last couple of months. We have a portfolio idea, and we're going to bring that to our clients. Greg showed you this slide. So if you look at that previous slide of the portfolios we built, it's very much on the basis of these new innovative thinking, for example, that the ARC research shows. I mean, if you're on Google, just go and look at some of the research that this manager's put out. I think it's some of the most worthwhile reading you can do, looking at their big thinking for the next year. So what does disruption mean, and how does it impact our client portfolios? This is a research piece, and all that it shows, if you look at the bars at the bottom end and you look at the last column on the right-hand side, it just shows you that the more you allocate to innovative thinking over the longer term, the higher your performance and at not much more risk. So it improves your risk-adjusted performance. And therefore, we think, as Greg also showed, investors shouldn't just be thinking about value and growth and blending these styles, but they should add a new style or a new box to their thinking, and they should add innovation, because innovation is everywhere. Innovation is within value, it's within growth, it's across all sectors, but start putting a focused effort in finding those managers or those funds that are really focused on innovation and new school thinking. So here's the portfolio. This was our first portfolio that we launched, the Global Disruption Portfolio, and we launched it in October 2020. And at first, what we did is we just launched it on 2 offshore stockbroker platforms called DMA and Swissquote, and our investors could either access it directly or they could invest it through tax-efficient wrappers. And we started the journey, and I can tell you that we've been managing this for the last 6 or 7 months. The fund's up about 25%, but it's short term. Very happy with the performance. This slide just shows you just a snapshot. If this portfolio was around, let's say, for the last 3 or 4 years, you can just see that it did well, and then suddenly COVID happened and we were all disrupted. And that's really what leveraged the performance. And one can argue and say, well, we've seen this massive outperformance now, and if you invest now, you're going to invest at the peak. But we think this is it's a 10-year game. It's for the next decade. It's about investing alongside this theme for the long term. And I think if you stand back 10 years from now and you look back, innovation and disruption will outperform the stock market. So we think that this trend will continue, albeit that you've seen this big divergence over the short term. And there you can see our performance. It's still short term, happy with that. It's in line with the benchmark of the short term. There's been periods of outperformance. There's been a bit of a rotation out of growthy type stocks more into value, as Greg showed. But yeah, this is for the next 10 years, and we shouldn't even be looking at the short term. So it's more just for out of interest. So what we further did is that we realized that we have to find an easier way for our clients to access our thinking, not just to come to us with their money. We take it offshore, we invest it via wrapper, it goes onto a stockbroker portfolio, then we have to go and invest in all these ETFs. It's a cumbersome process. So we set out to find a solution, and we found the solution, and we have now listed this idea, this portfolio, of the Swiss Stock Exchange, literally as of 2 or 3 weeks back. And our first money is flowing into what we call an exchange traded note. It's like a listed stock, a listed portfolio, literally in the next week. And then any investor, it doesn't even have to be a GraySwan investor. It could be somebody sitting in Kazakhstan with a stockbroker can go and buy this best of breed thinking by simply buying this exchange traded note. So we're not only thinking about strategy, we're also thinking about how do we make things easier for our clients to access and to invest in. And this is one of our thinking. So for example, right now, if Swissquote is your stockbroker, you can just ask the stockbroker, I would like to buy the GraySwan Disruption Exchange Traded Note. And you can see there at the bottom, the abbreviation of the fund is DSRPTU, Disrupt. Very easy, and then you can go and invest there, or you just simply contact one of our advisors and we help you to either invest in the portfolio or invest in the exchange traded note. I'm going to go a little bit faster and perhaps not show all the slides, but this is the thinking behind this portfolio. And ideally, we'd like to have a much bigger allocation to what we call the disruption composite. But at this point in time, we know that some of these shares are quite expensive. So we don't want to have an overweight to these funds. We are actually sitting back hoping for a bit of a drawdown so we can invest more cheaply, but we've got a decent exposure. You can see on the other side of that pie chart, what we've done is we have a big allocation to a different theme that we also think is disrupting called ESG, environmental, social, and governance factors. Greg mentioned climate change, green energy, solar, wind, all these things. And that is encapsulated in about 75% of the portfolio as we stand. For example, low carbon. Climate change is the biggest risk for the planet for the next 10 years. How can you invest in climate change and make money out of it? So you're investing for the planet, you're investing because you care, but you want outperformance. And that low carbon exchange traded fund is a manner in which to do that. You can see on the right-hand side, this fund is not just about technology. It's about healthcare. It's about disruption in financial services. It's about disruption in industrial companies, disruption in communication services. It's broad-based. So it's a very good way for any investor to start because it's broadly diversified. It's across various sectors, various industries, various themes. Here I can just show you one snapshot, and a lot of the terminology is going to be foreign, but we're trying to diversify this portfolio across many themes. Yes, you can see autonomous vehicles, the Teslas, the IOs of the world are big allocations, but it's across the board. You see 3D printing, you see beyond DNA, you see many other themes incorporated in this portfolio. Now, you may think, because I showed you in the previous slide that there's a big weight to autonomous vehicles, that we probably just a big investor in Tesla. Now, Tesla is a disruptor. But at the end of the day, if you look on a see-through basis, it is the biggest holding in the portfolio for the next 10 years, but it's a 1.74. It's not a big portfolio. It's not a big allocation. This portfolio is very, very well diversified across a number of disruptive stocks. And you can see on the right-hand side, this isn't just a US story, just investing in those big companies in the US that we all know, those FANG stocks. It's definitely this is not what about. So you can see there's about 62% in the US, America, and then very well diversified. And you can see there's a big component in Asia, in emerging markets. Why emerging markets? Because we think emerging markets are under-allocated to. If you look at the world stock market capitalization, emerging markets make up about 12% of the world in investment terms. But if you look at GDP, if you look at population, economic growth, then emerging markets have got a much bigger weight. And we think there are some big themes playing out in emerging markets, such as urbanization, technological advancements. And so we want to be over-allocated to emerging markets, and that's what you've seen in this portfolio. It's not just a developed market US portfolio. We did this interesting study. We saw this article in the Financial Times. This is about a year and a half back when we did all the work and put the portfolio together. And this article talked about the 100 most prospering and disruptive companies on the stock exchanges. And we then just said, well, let's just go and test what our portfolio looks like. And look at it, it's a big study. And I just showed you a snapshot of the top 4 companies and then the last 5 or 6 in that list of 100. And what we did is we actually went and said, well, what is our exposure? And you can see just in those purpley blue text that we have exposure to most of these companies, but there are small exposures. We are very well diversified. So we don't know which of these is going to be the next Amazon, the next Facebook. But what we know is if we have exposure to the wave of the innovative companies, we'll surely pick and select a few of those big winners for the next 10 years. So then healthcare innovation was the second portfolio that we started. And I mean, we all know that most of the money spent in the world is currently going beyond COVID and looking at healthcare pharmaceutical type of research. So we've got to invest behind this theme. it's not just the spending, it's about the way population and demographics are changing. There's more people wearing nappies today, more older adult people wearing nappies than babies, because the world, especially the developed world, is aging. So pharmaceutical care, healthcare innovation, it's not going to go away. It's going to become bigger and bigger and bigger. I mean, if you think Jeff Bezos is successful, and he is the wealthiest man on the planet today with Amazon, I think that person, via his healthcare innovation company that finds a solution for cancer, and maybe it's not far away, maybe it's in the next 3-5 years, is probably going to be the richest man on the planet in the next 3 to 5 years. So we want to invest behind that theme of healthcare innovation. And we've launched this portfolio about 4 months ago. And you can see, again, it's the same story. Since COVID, we've all been disrupted, and anything that disrupts or innovates have really excelled and catapulted. And we think this is going to be the case for the next 10 years. There's just a see-through of the portfolio. Again, a lot of the terms are going to be foreign, but like, for example, beyond DNA, that's what I'm talking about, is the DNA of us as humans. How can we look at DNA when we look at things such as cancer and finding a solution? And just out of interest, look at on the left-hand bottom side, we are not just investing in these big pharmaceutical companies like Johnson & Johnson or Pfizer. I mean, you can look on the right-hand side. Yes, we're investing in the big guns, but we're trying to tilt and skew the portfolio a little bit further to the mid and small size portfolio underlying holdings, because those are potentially going to be the Johnson & Johnson of the future, or the Pfizer of the future. So that's on healthcare. Blockchain. Yeah, we have views on crypto and Bitcoin and everything. We've even been doing some Bitcoin arbitrage for some of our private investors. That's a risk-free trade, but we're not allowed to advise on crypto, like Greg mentioned, because of the regulator. And look, Bitcoin and crypto is completely speculative, and we are not speculators. But we do believe in the technology that is disrupting the world, which is blockchain. And the disruption factor comes through in things such as digital assets. And let's say Bitcoin is a digital asset or a digital payment mechanism. And if you look at the world today and you ask your question, what is the component of digital assets? You'll see it's negligible currently, but in 3, 5, 10 years' time, it's going to be big. And we want to invest behind how the world is changing. And we want to invest in companies that build technology for crypto assets, for blockchain, Bitcoin, etc. Excuse me. Now, together with blockchain, we think there's a space for cybersecurity, because if blockchain or crypto or these type of platforms are going to be disrupted, who are the companies that's going to come and fix it? Or who are the companies that's going to make sure investors are protected? These are cybersecurity companies. And I did a presentation to a client of mine about a month ago, a large institutional pension fund, and spoke about cybersecurity. And it was the next day that we saw that cybersecurity story in the news about the pipeline in the US and the disruption it caused. And then recently we've seen President Biden just proposing billions to protect us against these cyber criminals. And at the end of the day, I do think that the next big disruptive event, or the next big black swan, is, for example, that we're all going to be sit here, we're going to be disrupted, we're not going to have access to the internet, or we're not going to have access to our systems. What do we do then? And that is where these cybersecurity companies are just really going to excel. We're going to have to call on them to come and help us. And we want to invest behind them. And if you look at some of the smartest guys around the block, the big names, whether it's the big banks, the JP Morgans, the Goldman Sachs, even the big pension funds or the endowments, if you look on the bottom end of the curve, these are smart people. They're investing in blockchain. I mean, Yale at the bottom, Harvard, MIT. These are some of the biggest institutional investors, and they've started to invest. So this isn't just a retail game anymore. the institutional investors have woken up and they're also investing. So we've created a portfolio. This one is, I think it's got about a 2-month track record, so very short, but we're in the running. And there you can just see, at the end of the day, we're trying to track and outperform what we call the MSCI All Country World digital economy over time. So again, if we can just be on that wave, I think there will be good performance for the next 10 years. One other solution is the commodities for change. I'm really going to spend time on 2 or 3 slides because we have that webinar at the end of the month. And I'm going to ask our offshore partner from Absolute Return Partners, Niels Jensen. He's going to join us to talk about commodities. Is there another big bull market coming or not? Where do we stand? I'm also going to ask one of our senior research analysts, Robert Robertson, to join us. He's been instrumental in building this portfolio and this idea. But at the end of the day, if one wants to invest in commodities, how do you do that? And currently, if you look at what's available, and we looked at all the big indices, they are all predominantly made up of old school thinking. You can just see in the gray bars, big allocations to things such as old school energy, oil, carbon. And for the next 10 years, carbon and oil, I don't know whether it's going to have a place. We're definitely moving to a zero carbon impact environment for the next 10, 20 years. So we want to invest in the new thinking for commodities. We want to invest in things like solar and wind, renewables, green energy. So we've created a portfolio that yes, it does have some old school thinking. It's got the old Land Rover thinking in it, but it's also got the new Land Rover thinking in it that's more innovative. And you can just see, again, since COVID, we've been disrupted and the new school thinking has outperformed. And maybe in the short term it underperforms, but for the next 10 years, this is the wave. It's new thinking and energy. And we've built a portfolio that we think is very, very unique. And we've already had offshore investors showing interest where we simply reduce the exposure to old school thinking and we bring things in such as, and maybe you'll raise your eyebrows when I'm saying we can invest in cannabis, but we can invest in water funds. We can be more smart and more efficient about water. Sustainable food. Sustainable food is when you go to Hudson's in Stellenbosch and you can buy a veggie burger. That is sustainable food. Grain, soft metals, lithium, battery technology, clean energy. So we're bringing some of this new thinking into a portfolio which you can't really find currently to invest in. And I'm quite surprised that nobody's come up with this so far. And you can just see, here's an example of, if you just invest in the Bloomberg Commodity Index, if you put your news screen on, you'll always see an advertisement about this index. But it's old school thinking. What we're saying is, let's convert some of the old school thinking into new school thinking, as you can see there. A much bigger allocation to clean energy, smart storage, and so forth. So that's commodities for change. So look out for the webinar. We're going to send the invitation in the next week. And the last one that we've literally just built in the last week or 2 is the smart property portfolio. These are green buildings. These are properties that care about things like the Internet of Things. I'm not going to give too much away at this point in time. Let's keep this a secret for another webinar. And we are running out of time. So in summary and conclusion, Greg showed this slide from Jim Rogers. You know, I always say that Warren Buffett is probably one of the smartest investors ever. He's got a way of investing. But sometimes we have to look at the way the world is, and we have to invest the way the world is. And what is a great example? One is that we have to look at the way millennials invest. Millennials are younger people. They think differently about the world. They're the ones that invest behind disruptive companies, cybersecurity, blockchain. They don't care about the old way of thinking. And millennials in the next 10, 20 years are going to be the biggest part of the entire workforce in the world. They're going to be the guys earning the big bucks. They're going to be the guys putting their money into the market. And it's going to create a wave like it's already doing. And therefore, we have to be on that wave. We have to be smart about thinking, combine the old school thinking, but be on this wave of new thinking and who are these new investors. So we have to think, how are these millennial investors investing? So in conclusion, we're going to send that YouTube video about the pet talk, about creating Space Jam. But that is what we set out to do 3 years back. It's been hard. It's been too slow. I wish we could have put this together much sooner, but we're in the race and we built these portfolios as from 6 months back. We haven't really told many about it. So this is today, the first time that we're actually telling our investors about these portfolios. We've put our own money in these portfolios. We've tested things. We made sure everything works. We found new ways to construct it, such as that exchange-traded note, to make it easier for our investors. And this is the journey for GraySwan for the next 10 years. Yes, we're going to have the core of our portfolios, like those unit trusts we've developed. We're even thinking about a new unit trust we're going to launch in the next 3 months, which is called a flexible unit trust. It's going to incorporate our best views, unconstrained, with South African assets and offshore. But these Megatrend thematic portfolios it's for clients that want to take their money offshore. And Greg showed you, and I think 90% of you also believe that it's a good time to take your money offshore. Where do you put your money offshore? There's a lot of great opportunities offshore. And we think we've got some good ideas for the next 10 years, and we will guide you through this. So I want to thank you. We're slightly over time. What I'd like to do, Bailey, if you can bring up a poll, we're asking a few questions, and I'd really appreciate if you can participate, and let's see some of your thinking and whether you agree with where we're going on our journey. So are we going to be disrupted in the next 3 years? Can we just continue the way we've been investing? Do you think Megatrend investing can complement the investment strategy? Let's see your responses. Give it a few seconds. It's taking a bit of time to get the poll through. While we wait, so in the meantime, what we will be doing is we'll be sending out the actual recording of this together with the slides to all the participants. We'll send that YouTube video, and we'll invite you to the next webinar, which is going to be only about that commodity portfolio. And there we go. Thank you, Bailey. Yeah, so I think we're all on the same page. I didn't expect 100% results, but we're going to be disrupted. Maybe we can be disrupted in the next 3 months. If we ask that question, not for 3 years, but 3 months, I would have loved to see the result. But black swans happen all the time. I must say the last 2 years I've actually got so tired of black swans that I thought maybe we should even change our business name because it's just happening too much. But that's what we're about. And can we continue to invest the way? No, we can't. We've got to adjust. So we're on the same thinking. And do you think Megatrend thematic investing can work and complement your strategy? That's another 100%. So I don't think we are thinking much differently than our investors. All that we're doing is we're providing you with options to invest. And that's the game. Strategy is easy. Implementation is hard. That's where we come in. So I thank you for joining us this morning, and I'm going to hand over to Nande just to conclude. Thank you, Nande.
Wonderful, wonderful. Thank you so much. I am definitely going to take questions because people did type them in before 11, so we'll afford them that time. Before I continue with the question section, just a comment from my side, gentlemen. I'm very thankful that you were able to contextualize the investment landscape. You were very transparent with us. You said it is hard. But I'm also thankful that I sense a strong confidence in your voice in that you said we are ready. We're not accepting any constraints. We've gotten the licenses that we need and constructed portfolios for our investors. So that is very positive, and I'm grateful. So I'm going to take a few questions from the audience. Thank you so much to everyone who has sent through some questions. The first one, gentlemen, is as a foreign national generating income in currency other than Rand, can I invest in these offshore funds with this offshore income, or must it be directly in Rand?
Great question. To invest in our best thinking, one has to get your money offshore into foreign currency We built these portfolios initially only in dollar terms. We will expand them into euros and pounds and all the other major asset classes. If you don't take the money physically offshore, you can invest in what they call Rand feeder funds or Rand feeder unit trust, but it's a very constrained universe and there are very, very few thematic offerings. I mean, we've actually looked at that and there's about 8 or 9 Rand feeder funds only that are really investing across the thematic universe. So to really have a best of breed, diversified, best thinking, thematic megatrend portfolio, you have to take your money offshore from rands, convert it into dollars, and then we invest either in the exchange traded note or through a stockbroker platform such as Saxo or DMA, and further speak to your advisor because you can do it on a tax effective basis through what we call a tax wrapper whilst when you take it overseas to invest. Rick, I don't know if you want to add to that question.
Yeah, maybe just, to Duncan's point, I think key is that from the tax perspective, if you invest into rand feeders, you'll get taxed on the currency move or benefit you get over the long term, whilst when you invest via a tax efficient vehicle, you won't get taxed on that currency move, but rather just on the capital gain you make excluding the currency. So it's quite critical to speak to your advisors in terms of most beneficial tax vehicle to access these vehicles. Yeah,
and just on the tax, those wrappers provide one with comfort that you won't be exposed to what they call CITES tax. And CITES tax is a tax that you can pay on these offshore companies that can be cumbersome and exuberant. So and that tax wrapper protects you in that way. So we strongly advise our clients to, as much as possible, consider those structures.
Fantastic. I've got a question here that says, excellent presentation. I agree with your views that we need to think differently and consider the mega trends currently unfolding. The question is, did you consider the trend around millennials and their spending habits in any of your portfolios? That's a good one.
Yeah, very good one. So the millennials is a broader theme movement that we are very aware of, as I showed you in that last slide. Perhaps the question was posted before the last slide because I really spoke about that. And so it's a big wave and we have to think about how they invest, and the millennials are investing across many of these themes. Millennials, for example, in the commodity portfolio, they don't want to invest in oil. They don't want to invest in old school commodities. The millennials are paying the price for previous generations' flaws and failures to care about the planet. That they don't want to invest there. So they want to invest in green energy and climate change and things that's going to save the planet and perform well. So across all the portfolios that we've developed, there's a big emphasis on how the millennials will invest.
Great. I mean, Duncan, you make a good point there. Just if you think about Bitcoin, versus currencies, the millennials are going to be the generation who's going to have to pay for all this debt that has been put into the system. Someone has to pay. No one speaks about how do we pay back billions of dollars being printed by US governments, being printed by European Union. And therefore, there could be this uprising against normal currencies. And maybe this is the reason for people moving to Bitcoin. So it's again this millennial thinking, which you really need to think about. But I mean, just to add to Duncan's point, it's not just the millennials, it's also you need to think of this aging population, because that will drive a massive trend in terms of where the world's moving in terms of healthcare, innovation, and so forth. So it's not just one sector of the population. You really need to think about the different sectors of the population and which mega trends will impact, on these different sectors.
Okay, great. So there's one that says, thank you, Greg and Duncan. Very informative and helpful. I believe in 4IR and related products. Blockchain tech, as you say, is what is a driver of more substance. However, one is seeing large asset managers gradually buying Bitcoin. We also see regulators having issued a draft comment note about cryptos. in your view, how long for us in SA before we get in there, please?
Sure, it's a loaded question. For example, if you look offshore, about I mentioned that one investment manager called ARK Invest, and in their disruptive equity exchange traded fund, they do have a small exposure to Bitcoin. So more and more managers are investing there. Some of the big commentators, managers, Paul Tudor Jones, these are old school thinkers that have actually come out very vocally and said that they are investing in Bitcoin. It's the new world. It's on the cusp currently. In the US, they've tried for the last 2 years to launch a first crypto or a Bitcoin exchange traded fund. We know locally a provider's tried on 2 or 3 occasions. It's not there yet. And of late, you've seen China, India, even the US starting to talk about they've got to regulate these currencies more. And you saw, the Bitcoin price came down from 63,000 all the way to just below 30. So it's kind of in limbo currently. It's a race of the different factions pulling. But I think that there's a place for new thinking, whether it's investing in crypto, which is speculative. We don't do that. But investing beyond the technology, we definitely think there's a place for that. So locally, we're always slightly behind the curve. The regulator has put out a draft, and we'd love to be able to provide advice on our thinking on crypto and Bitcoin and blockchain, because we've done a lot of research, but at this point in time, we're not allowed to tell any investors about our thinking. So just give us the leeway to at least tell our clients about our best thinking, and that's what the industry needs.
I mean, to add to Duncan's point, Nandi, I cannot see how the FSCA approves a digital technology for the SEC or the US, some of the biggest governing agencies. So that's what you need to keep your eye on. I know currently, I think there's 10 different ETF providers that has requested approval for Bitcoin ETFs. To Duncan's points, most of them have not been approved. I know ARK Invest is the latest one who's just applied for approval. So it's definitely on the cards. And I think to get in view of when this will be approved, just keep your eyes on the US. If anything gets approved, it will probably be first in that region.
Okay, fantastic. Thank you so much to everyone who sent through some questions. If we didn't get to cover your question in the live session, we will be sending out a recording as well as more information. I've noted down a few comments. I do want to equip you with a date for your diary before we log off and enjoy the rest of the day. Duncan did mention that we will have a webinar on commodities. You can jot down this date, the 22nd of July, same time, 10 a.m. And we will definitely send you an invitation and registration details for that. We're so grateful for your time. We thank you for your valuable input and engagement. Till next time. Bye.